Let me see if I can make it a little bit bigger. See, just falls short of it. The fact that it goes up there and doesn't touch it and then closes here, I know, I know that that right there is a bearish order block. I can trade after the next candles come up and bump in the bottom of it. I'll trade short there. All it has to do is move away from it and then come back up into that. I can trust this candle not being overtaken. What's the next candle do? Goes up to it, but doesn't touch this line, and it doesn't even breach the candle's high. Now, if it would have traded up and touched that midpoint and then did that, I would not have taken that trade. I would have waited for another attempt to get in there and work just a little bit above the consequent encroachment, and then I would try to go short in this upper part there. That's what I would have done differently. But because it didn't and couldn't even touch the consequent encroachment, these are PD arrays. And yes, they're used for very specific and static levels to enter and exit on. But I also use these same price points as a means of measuring strength and weakness. If this candlestick can't even touch that, but gets close to it, it's signaling. It's a signature. That's an algorithmic signature for someone that knows what they're looking for. That tells me that when this candle closes, all I need to do is see it move away and come back up and touch the bottom of that, and that's a bearish order block. Yes. Now, with that logic, I can be short and take a partial below here, or if I know that I can trust that it's going to go down below the London lows, then I'll put a limit order below that. And then I could sit and explain to my son that I think it may go down to those lows, but I'm positioned now that if it doesn't need to do it today, it'll probably go down there in the London session tonight. Where? To the new day opening gap down here. So with all of that narrative explained to you, let's put the executions back on. There you go. So now we have the market displaced below the bearish order block. This candle here, we open and trades up. There you go. It trades up, touches it, go short. There's your low. What's the low of that candle? Look right here. See that candle's, see that price right there? Right above my cursor. That's the low. What's the low of the candle? 18,320 and a quarter. Okay. The fill, 18,321 and a quarter. So as it's bumping into that, I'm selling short right there. And I want to see it aggressively run below here. It does. Go back for a second. The fact that we traded up here and we didn't touch the consequent encroachment of this, I like to see if there's two fair value gaps, because we have here and we have here. You have to at least anticipate that it may go up into that higher one. But if it fails at the lower one's consequent encroachment and there's a news driver coming, I have no problem, no fear of absolutely none of getting into the trade. If I did it wrong and I get stopped out, I've shown executions where I've done this. My students have seen it. It's on my YouTube channel. It was on Twitter. You've seen me get stopped out, and then I go right in there and I do another entry and it pans out. Or if I did it wrong and I know that my direction was off and I'm offside, I reversed and did the other direction, and then the partner just goes the other way. That is going to come by experience. So invariably, if I address or field the questions that come to me, a lot of these questions will be answered with your own experience, and it's an unfortunate cop out sounding response, but that's the truth. You're gonna feel comfortable doing certain things that you aren't going to be comfortable even imagining doing at the beginning of your stages of learning. So I wanted to see this stay open. Okay, I wanted to see it fail to get to that midpoint of the lower one, because it failed there. Okay, wonderful. I'm not worried about it. But go back to what I was saying. If it would have touched the consequent encroachment and this candle, I would have anticipated trading up into the higher part of this. And then my stop loss would have had to be above the midpoint of this consequent encroachment. You see how this gave you everything that is logic based. This is your guidance These are the things I've already taught. They're in all the discussion points of everything I've ever taught on this YouTube channel. All these things, unless I said my students have never learned that, everything else has already been taught to you. But because you didn't write anything down and you didn't take notes and you're just falling asleep to it, because a lot of people use me as a lullaby and they just listen to me and go to sleep, which is fine. You know, whatever. I'm glad I can help you sleep good. But everything I've taught, unless I'm saying to you, this is the first time even my students learned it, I'm expecting you to already have it in your journal, in your points of understanding what these things are expected to tell you. But anyway, it drops down, and then we have an immediate rebalance. Okay, so we have the market trading down here. We have a big down closed candle. The market trades back up. Boom, bumps into it here. Immediate rebalance, and then I get a little bit of heat here, but that does not take me underwater. This was only, it would still have like $1,700 in profit even with here. Why? How can that be possible? If I'm entering here, look at down here. If I'm entering short there, why isn't that giving me drawdown in the trade? Negative drawdown, let's say it that way. Because the larger trade entry is here. There's 6 contracts here, and you see me doing this all the time. This is my model. 6 and 4, 6 and 4. So 6 contracts at the higher price if I'm short. The secondary affords me, when I'm only doing 4 contracts, it affords me to trade above that entry. It's forgiving because it could do what? It can revisit this fair value gap. It can trade inside that, but I don't want to see it do that. So I had to have a little bit of heat there, but it doesn't fill it. It just goes up to that level there. And what is it doing there? Is it touching the consequent encroachment before it makes the swing high here? Nope. So that, what does that tell me? It signals to me, just sit back and relax. Don't do anything. Just relax. Move your stop to your first entry, minus 2 ticks, and just relax. Just relax. And now we go into 1 o'clock. Look what happens at 1 o'clock. They pump it and then dump it. Small little fair value gap right there. All you're doing is you're studying price and you're seeing every SIBI. Remember I was telling you yesterday? When the narrative's in play and it's going to go lower, or your analysis is assuming that it will go lower, you're looking at how the market is treated at every SIBI, sell sign imbalance, buy sign inefficiency, or a fair value gap that has a down close. It's defined by this candle's low, this candle's high, even this range is that far down. This is the only imbalance. So we have a little bit of an overshoot there. That's called a mohawk. It's just a coloring outside the lines. I talked about it yesterday. It doesn't change anything. It doesn't change it. Did it take out this high? No. All it does is it went outside the boundaries just a little bit, and the next one gives you peace of mind because what is it doing? It's stopping right at the high of the fair value gap. What's the high of that candle? You're going to look right here, upper left-hand corner. Look at that value right there. What's the high of that candle? 18,283.75. What's the low of this candle here? That's right here. 18,283.50. It's not going outside the realm of what you would expect price to reach to and then move away from. Is that proving to you that sellers and their selling pressure had the ability to stop it like that? It doesn't do it to me. You'll never convince me of that. You'll never convince me that sellers and buyers stop every bit of one of these terms in all these PDA arrays, right to the tick or the point or within a earshot of it. You're never going to convince me of that. And even if I didn't believe in an algorithm, I would think that it was something other than that. But thankfully, I don't have to. But the market trades aggressively after 1 o'clock, after we have a retracement. So here we have model 2022. Here we have optimal trade entry. Easy, isn't it? It's easy when you have all of the guidance and rules in place. And you do the things that you're taught to do, focusing on the time of day and anticipating the delivery of price based on factors that call price to it. New day opening gaps, new week opening gaps, relative equal highs, relative equal lows. And then below that, in terms of importance, you have inefficiencies. Inefficiencies are subordinate and less important than relative equal highs, relative equal lows, or new day or new week opening gaps because their influence over price. The algorithm will refer and prefer more importance and significance placed around them. I'm not going to tell you the logic behind that. Just trust me on that. It'll serve you well. You don't need to know anything beyond that. When you drive your car, what do? You push the button or turn the key. You don't need to know how all that stuff works under the hood. Same thing here. Gaps, when they're actual, like new week open and new day opening gap, that is absolutely going to be much more significant because there's a lack of trades there. Inefficiencies, I'll say this much. You have one side of the delivery offered to it, meaning that, for instance, let's go back to this one here. This sell side imbalance, buy side inefficiency has sell side delivery. Okay, sell side delivery is always one-sidedness moving lower. Sell side liquidity is what's resting below that low. The London low, or relative equal lows that this line is here, remember that's this over here. That's these over here. Okay, that is sell side on the daily range. That's the lowest it's moved for the day overnight, London. So it's going to want to try to gravitate to that too. That is real orders. That's not inefficiency. There's real pending orders down there. That is the lifeblood of the marketplace. Real buy stops, real sell stops. That is the heartbeat of what makes these markets go up and down. In between that, okay, in between that, you have inefficiencies. Inefficiencies have one pass through. So they have delivery. In this case, we have sell side delivery, but what is it lacking? Buy side. If I'm bearish, I don't want to see buy side offered because what that's telling me is I don't want to see it trade in the upper half of this. I don't want to see that at all. In fact, I'm enamored when I see it not even touch consequent encroachment. I basically get a hard on from that. I am turned on by that when I'm in a trade. I get so cocky and arrogant. You see it in my trades, or I'll annotate it. I say very facetious things because I see not just this signature, but other things I'm not going to share with you, and then that pisses you off. Oh, you say you're an asshole. You're not teaching me everything. I'm teaching you more than anybody else would, and I'm teaching you how to make lots and lots and lots of success. Therefore, money, bread, dinero, moolah, fun coupons, right? The fact that we don't touch that consequent encroachment or midpoint, man, that tells you what? It's really heavy. Because otherwise, it would be natural for it to come back up in here, trade there, close it in, and it could still roll over. I don't like those kind of trades. That's Chris Laurie stuff. Chris Laurie stuff is let's fill the void. That's not a void. That's a sell side delivery. It's imbalanced. It's only sell side. It's inefficient in its buy side. It's not gonna be balanced if it just trades up there. That's not balanced. Okay? It needs to go there and then leave it. Then it's balanced. That's a balanced price range. So we're not talking about Chris Laurie stuff, and you need to stop leaving those comments in my section. Okay, I made Chris Laurie a millionaire by pushing lots of people to him, and I'm never going to rip him again. I've seen emails where he's talked about me, two-faced out both sides of his mouth. He can kiss my fucking ass. So there's your skinny on Chris Laurie. But the point is this: at 1 o'clock we have an up close candle, and it pumps it. And what's it doing? One candle is moving up. So people that are watching that and they see this go up, even though it's a 1 minute candle, that triggers people that watch 1 minute candles. Hey, I watch ICT stuff. I watch people that trade smart money concepts. We're watching 1 minute charts. 1 minute charts is the bee's knees, baby. You can't make any money unless you're trading a 1 minute chart. When they see this do that, they're like, oh, here we go. It's making a failure swing. It's going to go up. And this is probably going to turn into an inversion fair value gap. And it's probably going to go for those relative equal highs up here. They chase something so minute and insignificant, losing the entire plot that it's going to want to run the London lows. And now, as I taught you today, it's going to try to gravitate to new day opening gaps.